Maduro was flown to New York. The court charges are public, but the most revealing line came later. Trump saying U.S. companies will go in and fix Venezuela's oil, and that America would run the transition. That's not subtext, that's policy. If you think this ends at the courthouse, you're missing the second front: refineries, tankers, and reserves. In the next minutes, we unpack how a night raid in Caracas became an energy play, and why global markets are already gaming the next move. Before we move on, please take a moment to subscribe to the channel and like the video. If this was just about cocaine, why did crude desks start building cargo slates for Venezuelan blends before the jet even hit U.S. airspace? Because the math screams oil. Venezuela sits on the largest proven reserves on paper. The crude is heavy and sour, but the volumes, even throttled, move global spreads. A broken system can still scare OPEC when it hints at a comeback. Traders moved early because barrels, not court dates, set margins. Now the hard part. Caracas has the reserves. PDVSA has refineries and upgraders in name only. Years of debt, sanctions, and deferred maintenance hollowed them out. Turning wrecked assets into leverage fast enough to justify a high-risk grab requires cash, waivers, and crews on the ground. The clock runs on corrosion, not headlines. If the restart drags, value evaporates. If it's brisk, discounts narrow and the winners are set in weeks. On paper, the reserves round past 300 billion barrels. Under today's kit, only a sliver is producible at pace. Output once peaked around 3.2 million barrels per day in the late 90s. In recent years, it hovered near 0.6 to 0.8, with exports choked by failing units and sanctions workarounds. Proven doesn't mean flowing. It means oil you can count if you spend. And this slate needs more than valves and a memo. Heavy crude needs upgrading and diluent to flow and meet specs. The Orinoco Belt lost key upgraders and reliability long before any courtroom hearing. When those units sputter, fields stall, no matter who signs the orders. Without naphtha or light crude to cut viscosity, pipeline friction wins and tanks back up. The choke points are simple and brutal. Upgraders at the Jose complex, trunk lines to the coast that need pressure management, storage at Puerto La Cruz and the twin refineries at Amue and Cardon, port capacity at Jose and La Guaira that sets the ceiling for departures. Each node carries risk, insurance, and a price tag. Sanctions and neglect created cascading failures. Desalters foul, compressors lose seals, hydrogen units limp, and sulfur plants trip. Restarting them isn't a wrench job. It's tens of billions in parts, crews, and time. Which leads to the only question that matters to capital. If Washington stages the handover, how fast do barrels hit water, and who lifts them first? Even a cautious recovery that taps a fraction of the reserves represents multi-trillion-dollar in-ground value. The real fight is over which 0.5 to 1.5 million barrels per day return first and on what terms. The courtroom decides guilt, the market decides price, and the timing points to pipelines and ports, not prosecutors. The first explosions weren't at a courtroom. They cracked over airfields, ports, and the highway that feeds Jose. Those are the switches that move barrels, seize them at dawn, and daylight markets adjust by lunch. When the runways go quiet or clear, and the harbor pilots know who is in charge, trading desks don't wait for press conferences. They mark risk, they mark timing, and they start calling shipbrokers. Look at the map the operators used. La Carlota to shut down or secure the urban air picture. Fort Tiuna to control heavy roads, fuel depots, and command nodes. La Guaira to handle deep draft traffic and customs choke points. Higuerote to stage smaller flights and rotary lift into the coastal strip. Stitch those together and you get an air and sea corridor that lets technical crews move with escorts and lets crates of valves, seal kits, and meters arrive without delay. The same lanes that move detainees also move diluent. So was this planned as a legal snatch or an energy corridor? For markets, the distinction fades when airspace is deconflicted and portmasters follow a single channel. If cargo inspectors can board without harassment, if flight plans clear in minutes, spare parts ride the same routes as military cargo. Naphtha shipments for blending can follow on small tankers once vetting firms say the berth is safe and compliant. This is where insurance rules the pace. War risk premiums drop when patrols control approaches. AIS transponders stay on, and port authorities publish clear notices. P&I clubs want proof of safe passage and documented chain of command at mooring dolphins. VLCCs can't risk blacklisting. Suezmaxes won't show if sanctions are murky. Secure approaches and clean paperwork change that math quickly. Control also flips the light for service firms. Halliburton and SLB won't mobilize a coiled tubing unit until they see a schedule, fuel assurance, and a protected laydown yard. Rig reactivations need a 30 to 90-day window, visas, and bonded warehouses for tools. Midstream players watch for tug availability, pilotage slots, and whether Jose's loading arms pass a dry run. We've seen this sequence before. After Iraq in 2003 and Libya in 2011, fragile perimeters still allowed early surveys, compressor checks, and phased lift capacity within weeks. And with a public promise that U.S. firms would go in to fix assets, the short list is already thinking about which berths, which upgraders, and which pipelines move first. The opening gambit created a corridor for immediate assessments and future flows. With lanes open, the next move is corporate. Who gets the call, and how fast can they turn valves without breaking the law? If Washington runs the transition, who signs the work orders for the first $1 billion? Start by splitting the money and authority. Upstream rights sit in blocks and joint ventures where production sharing or joint service agreements define who can lift. Services live on separate contracts for rigs, workovers, and surface kits. Midstream constraints decide speed. You need diluent for Orinoco blends, critical spares for compressors and desalters, and steady hydrogen to keep upgraders from choking. Each lane has a different legal gatekeeper and a different clock. The legal drag is real. Sanctions licensing, contract disputes, old arbitration awards, and PDVSA arrears can freeze big checks. Major operators may have assets and know-how, but they also have compliance teams that move only when language is clean. Smaller or purely service-focused firms can mobilize faster because they don't take title to barrels and can work under targeted waivers or subcontracting chains. On the short list, U.S. firms with heavy oil chops matter. Chevron already holds waivers and active joint ventures in the belt, so incremental lifts can come from workovers, flow line repairs, and quick debottlenecking. ExxonMobil has deep, heavy crude expertise from thermal projects and coker integration. ConocoPhillips sits on claims history that shapes leverage in any settlement, which could convert into participation or cash that funds a targeted restart. Chevron's licensing and live operations make it a fast mover. Prior cargoes, established JV governance, and known lifting programs cut weeks off planning. That advantage compounds when you add access to naphtha streams and coker-friendly blending that buyers understand. Services unlock the first barrels. SLB, Halliburton, and Baker Hughes can run coil, acidize, swap ESPs, and fix gas compression to bump field pressure. EPC giants like Bechtel and Fluor take the larger checks to rebuild hydrogen plants, sulfur recovery, and the Orinoco upgraders distillation and coking trains. Their schedules hinge on port laydown space, bonded storage, and grid stability around Jose and Puerto La Cruz.